Okay, so we're going to be here for an hour for what I'm hoping to be a useful session for all of us. It is time we put a little emphasis on running some tests and thereby actually building confidence in our work. Because whichever system you end up using, this one or the other one, or maybe you build one for yourself, it doesn't matter. You have to crunch the numbers because that's the only thing that will give you confidence. And with that little note, let's jump in right away. So here's the agenda. Before we start the works, I just wanted to put this out up front, some basic starting points. So, right, the first thing is each of us wastes a lot of time with bumping around between systems and methodologies and trying to figure out how to make money on the markets. That can take months or years, or even sometimes it will never end for some people. And I'd like to give you some hints based on my experience only, of course, so others' experience may be different, but I think by and large, these could be some hints that may help you avoid wasting years of your own time while you are building your trading business. First of all, anybody ever on the planet that promises that this is going to be no effort, that is not true, just simply not true. So if you ever see that, just move on right away. People or entities that never discuss the problem of randomness in trading do miss the point in such an extent that if it was my time, I would move on right away. You cannot talk about participating in the financial markets successfully without understanding and tackling and doing something with the problem of randomness. That is one major problem in trading, and if somebody doesn't deal with it, that is a big red light for us. Okay, and then this usual thing, I jump on YouTube and I just type in something and 2,000 videos come up and everybody's talking about high probability trades. I mean, who cares about high probability trades? What we should care about is the edge. It's like when you drive a car, you need 4 wheels. Let's assume you need 4 wheels. And then one guy just talks about the 2 front wheels. I don't want to have that car. 50% of the equation and ignore the win-loss ratio, then that just means that you're trying to fool me. And also the same thing. This is just the same thing with different words. Accuracy, high win rate, promising you high win rate is basically promising you the dream of no pain. But as we'll see, there is no gain without pain. We have to be comfortable with the pain in order to gain. So anybody who wants to, working hard to hide that fact is probably not something we should focus on. And I'm being polite. Okay, the next one. These, I'm sure you've seen these fantastic equity curves. No pain, everything's fine. You just winning trades all the time. This is nonsense. Just look at the work of trading legends. There's a couple of books, you know which one I mean, which contains interviews with very successful traders, documented successful traders. Everybody has drawdowns. It's just part of the game. Actually, one challenge that we're going to tackle this month would try to help all of us to figure out what size of account do we need to start with in order to survive inevitable, if I can pronounce the word, drawdowns as we go about trading. Because you can have the best airplane. If you're flying too low, you're going to hit a lamppost or a hill or something. So we need enough money to survive the bad times, which are just around the corner usually. Let's see. Right. The other thing that is just a flashing light for me is growing a small account into a big account in whatever, 3-4 days or 3-4 weeks or nonsense. Probably it can happen like everybody, every weekend, somebody wins the lottery. But the chances of that being you or me are quite slim, to say the least. So basically, we can ignore that. It's almost zero. Yes, it can happen, but it's not a business plan for us. Right. And this is a little psychology. You know, everybody knows Mark Douglas, and I do respect the man's work. He has some good books out there. You should check those out. One challenge in trading is that the usual strategies that work in our everyday life usually do not lead to success on the markets. So we have to develop a different attitude, a different skill set that would otherwise be leading to success in normal life as a dentist or lawyer or a driver or a pilot or anything. But those skills turn out to be mostly useless in trading, and a very different skill set is needed. And without that, I could give you the best system in the world. As a trader, you or me, or if we're not ready, we wouldn't be able to execute the system because of the constant doubts and psychological trauma that we would have to go through with each trade. And we'll say a few more words about that a little later. So developing the psychology of successful trading is very important. And I think that crunching the numbers and building confidence based on facts, statistical facts, is a very good and efficient way to start changing the psychology and developing the skills needed to do this job. Right, and this is the last one. You might say you don't hear this too often, but it's not so rare for this to be discussed in detail and at length in the academic community, which is the scientific study of crowd behavior. And we make a strong claim, but I stand by that claim, is that our algorithm, our product, is a result of a rigorous study of crowd behavior for more than a decade, which resulted in this product. And I think since financial markets, if you think about it, any chart, any dome, anything that we ever look at, any liquid market is just a bunch of people, a crowd, just like a herd of elephants or a school of fish is just, or a group of people at a baseball game or a soccer game. There are patterns that will surface in the crowd, and those patterns are usually tens of thousands or millions of years old. So they usually do not change too easily. And that gives us a pretty good chance of coming up with some kind of method that could capitalize on some smart observations of crowd behavior. Right. So if you just look at these little notes in bold, and perhaps again, you can add your own or maybe substitute a couple with ones that you have noticed. The point is, make a little list for yourself. And if you know what to look out for, you can save yourself a lot of time, in wasted time that you would otherwise spend searching or chasing so-called systems which lead to nothing. And the same rules apply if you choose to develop your own system. Let me mention right here that we have 9 indicators that we think are quite useful. All of them are completely usable to build your own system. For example, if you want to build your systems with Bloodhound, then all our products are completely compatible with Bloodhound and Blackbird. So you're most welcome to build your own system and look at what indicators we offer to do that. But again, if you don't want to spend another year doing that, then we have something. We already spent 12 years working on the standalones. So again, you may choose to look into this a little closer, and that might also save you a couple of years of research and looking for ways to become profitable. And finally, I am making a strong claim, but I stand by it. I do make the claim, and I do think, and I'm convinced that the standalones, our product, will pass all these tests above on this list. So no BS here. Let's move on. And especially if you're new or if you've never seen this, then let me just ask you the question, what 3 things you need to be successful in trading? You'll see that one If one leg is missing, the chair will not stand. So type in 3 ideas here for me, please. Let's see what everybody says, because what I think is, I know already what I think. I want to know what you guys think. Money is one thing. One leg, definitely capital. Thank you. What else? And enough of it. Motivation, knowledge, money management. Yes. Jeff, this is a great point. And you know what? All this, I'm going to call skills. Without skills, you could have the money. You could buy a winning system, a proven winning system. An unskilled trader would not be able to withstand the storm that goes together necessarily with every trade we ever make. So you do need skills. What's the third one? Rules, yes. What about those rules are losing rules, Rick? What do we call winning rules? Yes, but what if it's a losing strategy? This is how we started. This is the third one. The edge is a statistical advantage, which means winning rules, which means winning strategy. And by winning, I mean that this number here is bigger than 0. That means that it has over a large number of trades, the strategy, that set of rules, as Rick mentions, produces a positive result. Of course, there will be losing trades, winning trades, all kinds of trades, but after 10,000 trades, we will have made more money than we have lost. That means that we have an edge. Because of the drawdowns, we need enough capital to survive the downtimes, obviously. So yes, okay, so going back to this, remember this, please. There's no getting around this. An edge is needed, enough capital is needed, and skills are needed. Right. Especially if you're new, this, again, it was mentioned on a video. I'm going to make it very short, but this is a crucial point. One crucial point today is the chair with the 3 legs. The other crucial point, if you understand this page that I'm showing you now, you have already made a very big step towards success in trading and investing. Because what this chart shows, again, this was already mentioned in some of the videos years ago, but I brought it out again just to highlight it as we start the October sessions, that we need to remember trading is a wicked environment, and wicked environment is an academic terminology. And all that it means is, imagine a piano player. Imagine you have a child. I have a child. I'll send the child to piano lessons. And what does a good piano teacher do? Well, when the child does something good, the teacher reinforces good behavior. And if something's not good, then corrects bad behavior so that the child or the learner, from the responses of the teacher, the environment, help the learner to develop the proper skills. And then progress is made. Now, unfortunately, the financial market is not like that. We can do everything correctly, and then we'll be punished by a losing trade. Or we can be reckless, and then we get praised by the teacher in the form of a winning trade, teacher being the market. So our behavior is not necessarily correlated one by one, each trade by each trade, with the results. It will be correlated over a very large number of trades statistically, but for the human mind, it's very difficult to think in 10,000 trades or 1,000 trades or even 500 trades. We think of 1, 2, or 3 trades, the most recent memory or the next trade that's coming up. This wicked environment makes trading very, very difficult. Very difficult. But being aware of it is the only thing that gives us chance, because we need to conquer this little challenge here, and it can be conquered if we understand the situation that we're in, the environment that we're operating in. We have 2 circles on the chart, by the way, 2 circles. One circle is green, the other one is red. The overlapping area is just a different color to highlight the overlap, but we're dealing with 2 circles. The green circles are identify market imbalances. Buyers, sellers, think about the situation differently. Think of the real estate market, the milk market, or the car market, any market, financial markets, instruments. futures, whatever. There is a market with buyers and sellers. If there's an imbalance, or when there's an imbalance, the price will move to find a new balance. That imbalance is what moves price. Now, tragically, in quotation marks, these imbalances are not shown on the chart necessarily, because the participants, as we know, do their best to hide their steps. If you're a large trader and you're wanting to buy whatever 10,000 contracts on something, well, you're not going to just put 10,000 market orders. That would be ridiculous. And your client probably would fire you right away, or your boss. You'd have to devise a very sophisticated algorithm that builds up a position step by step. So market imbalances, intentions by traders, are not always shown on the chart. Keep this in mind as we move on. Market imbalances may or may not show on the chart. However, okay, on the other hand, we have patterns. Patterns on the chart, whatever patterns you think of as important. For us, consolidations are important, but you can think of breakouts or antis, some other patterns that we focus on. Yes, patterns are the ones that show on the chart. Getting back to, I think, page 2 on this page here. This is a random chart, a completely random chart. There is no edge in this chart. It's a random sequence of numbers. But every time I press F5, reload screen, you get a different chart, just by random. Now, you see, it's a totally random process. But even in a random process, there are strong trends emerge. There are pullbacks and breakouts and all kinds of stuff emerge all the time, although the process is random. I can press F5, I can play this game all day. In every chart, there will be areas which look like a trend. Yes, well, but it's not really a trend, it's a random process. There's no trend, there's no intention behind it. Same way, the patterns that we see on the chart, even the best looking pullbacks, could be just a fluke of random chance. We will never know. Okay, so again, just to sum it up, green is the actual market imbalances by traders. They're usually hidden, or at least they try to hide it. And on the other hand, all the time we see patterns on the chart, which may or may not be actual usable indications of market imbalances, so we will never know. Ironically, some of these random chance patterns that we may trade, we enter the trade, it turns out to be a winner. That's not a proof that there was an imbalance, because it could be a winner just by random chance. A certain subset of our winners are winners by random chance. Also, a certain subset of our losers were actually imbalances, but they just turn out to be losers by random chance. Now, what we ideally, which is unattainable, but ideally what we want is our trading to only be focused on the yellow area, which is the overlap between the two, which are actual imbalances and also show on the chart. You see, two requirements must be true at the same time. They are actual imbalances and they also show on the chart. Those are the yellow ones. That's what we want to trade. We don't know when we enter the trade. See, when you enter a trade, you don't know its color. You don't know if it's, even after the trade, you don't know. You will never know what color, what category the trade belonged to. So this is something, this is called a wicked environment. We don't know, and we still need to act based on incomplete information. The only chance we have to be successful in an environment like this is statistics. Doing the work, crunching the numbers so we can put the odds in our favor, and this is what we call an edge. Okay, so let me see, Jeff is writing something. 6-7 losing trades in a row. Yes, 6-7 losing trades in a row are quite possible a characteristic of a otherwise very successful system. Actually, on our website, I don't want to be sidetracked all the time, but on our website, we have an area for calculators, and you may want to hop on those. So if you go to resources and calculators, you'll see a couple of calculators here. Let's see which one might. System metrics. And this is a very smart calculator. You enter your data coming from your back tests or coming from your trading, simulated trading, whatever, and it will tell you the longest expected losing streak, which means how many losers you need to reckon with. And there is a little mathematical formula. This will help you to calculate how much money you need on the account to successfully trade a system with a certain set of characteristics. Please remember two things: the three skills, the three requirements for successful trading, and trading the markets being a wicked environment. And we need to adapt what the environment we're operating in so we can turn the edge in our favor. So what can help in this difficult job? Because it is a difficult job. What can help us is statistics. It is freely available online. Nothing really more difficult than high school math, not even high school math. It's just common sense and some rigorous processes and trying to make numbers keep us objective. That's what we want. Okay, and why is this work important? Because one way or the other, we need, as we enter the trade, I need to have confidence in what I'm doing. Without confidence, it will not work. I'm going to screw up my own trades. I'm going to get out too soon or stay in too long or not follow my rules or something. We need to do this work in order to build confidence in our system. Okay, now one last note. We do have a software product and we're going to look at it in detail. But the point is, our software product is designed in such a way that it can be customized. The methodology itself is rock solid. You can customize the methodology. The methodology is patterns in crowd behavior. But each of us have different preferences, account sizes, time zones, countries, whatever, currencies, any age, money, all kinds of situations. So you need to customize the software to your needs, and you have to have a written trading plan, at least a piece of paper that tells you what you allow yourself to do as you trade and what not. The trading plan can just start with 3-4 sentences, and you can expand on it as you go forward, move forward. So you don't have to think of a 20-page document right away. Just cement it in your mind what you allow yourself to do and what not. And all right, yes, the final thought is that this is a work that must be by you. I cannot do it for you. I cannot build your confidence. I can offer and talk endlessly about a product or about our services that we are offering. And I will do that, and I've been doing that for years. But at the end of the day, you have to get down to it, and you have to open up the hood and get your hands dirty and do the numbers, because you can't build confidence by listening to me. Don't believe me. Do the work yourself. Hard, but actually quite interesting work. So I don't want to sound negative here. This work is quite interesting and can be very beneficial. Evidence-based confidence. What else? That's what we need. You know you've done your work, and you know what you're doing, and you can execute the job because you know the long-term results. You've done the numbers. That's what I'm trying to help you with this month. So 2 books that could be helpful for further study. So probably it's in your local library, or you can get it online. And have a look at them, see if they can be of help to your trading project. All right, now it's really time to hop into Ninja, and also ask you to type in any questions at this point before we start running the actual test. as you watch this, and maybe on your own machine, you can do the same thing, or of course you can design your own test. Now, one thing, then let's start with this right away. Testing is also, we say it's very objective because it's numbers, and it is what it is, and you can't argue with that. That's all true. But please remember, in any research project at any level, there's a test where there's a step where you design the test. What to test, how to test, what to test for. These are subjective human decisions. So although the end results, of course, is numbers, which is objective, but there's also a little bit of subjective element at the start, because we need to decide what are we going to test for. Some of my preferences will come to surface necessarily, and you may not, you don't have to agree with them all. The point is I want you to think about these for yourself and make your own decisions. Design your test that way. Why not market replay? We could be here in market replay, but even if I played market replay at maximum speed, we'd be here for many hours, because what I'm going to do here, I'm going to actually run some tests for 3-4 years in the past, like 10,000 trades. 3-4 years in the past, I don't have market replay for that. Even if I did, it would take a week to run it. On our YouTube channel, there's lots of market replays running, a month in an hour. I ran 1 month in an hour market replay, sped up the video, and you could watch all the trades in a month in just 1 hour and see if what the algorithm ends up with. We are in the BTX workspace, and this is just the usual workspace. ProSDR, BT, and BTX, all these 3 workspaces are just built for convenience. They run on the same algorithm, so the same code is used when we run the tests. Basically, we're going to focus on 2 kinds of tests today, if we have time: back tests and optimization. And just to state the obvious, a back test, what does it do? What it does, it runs some tests with the computer. It's a simulation, obviously, because this never really happened in the universe. We pretend to have performed trades, executed trades that we actually never did. We never participated in the market. Our order never was there, but we are simulating something as close as possible with the software, like how many contracts and what time and all these settings. What would have happened if I had run that strategy on a given market in a given time span? So here's what I'm going to do here, just to start our testing. I'm going to focus on US futures. For futures, okay, I could play endlessly. I could play around with the settings, but I usually stay in a 15-minute chart. It's intraday enough, but also remember, we trade crowd behavior. By definition, we need a crowd. In 15 minutes on a US futures, we have enough crowd for our patterns to surface. If we don't have a crowd, there will be patterns on the chart, but the likelihood of them being useless is higher. We do need a crowd. We're going to choose 15 minutes. Later, you can do your own tests in any way you want. This is just an example. All right, now, okay, first of all, I want the test to be ending today. Okay, and let's say January 1st is good, but I'm going to go back 4 years. So this is, okay, 4.5 years, a little bit more, 4 years and 10 months. Good. That's a large sample size for us to be able to draw some conclusions. So again, if I had just 10 trades or 20 trades or 50 trades, that doesn't mean much. But 6,000 trades, hopefully that might mean something. One thing I want to avoid is to try to fine-tune it to too much. I'm just focusing on what really matters. So in this test, I'm just going to use market order. I am aware of the fact that there will be slippage. Market order, there will be slippage. 6,000 trades, that's a lot of ticks that I'm going to lose. But note this, you will see after our work is done that I'm starting with the least potentially successful system. So I'm giving up a lot of ticks, in other words. I want to see what I get if I don't worry about the details too much. So market order, using market orders is part of that decision. Okay, some of the finer points in our software, if you are using 370, you know that we have certain settings. I'm not going to force the exit now. I want to stay in the trade. Now here, in this area, this is actually important. So order sets. Okay, so I have to decide how many contracts I want to use in this test and what those contracts should be doing. Should I be trailing them? What should happen once I'm in the trade? Again, I am starting with a very, very simple situation. So the edge contains two ingredients. One is very simple, nothing new here. One is the percentage of trades, my trades, which are winners or losers. We call this accuracy. The other one is the win-loss ratio, which means what's the proportion of my average win compared to the average loss. If I put this in an equation, then I will end up with a number. And if this number is bigger than 0, then I have a positive edge. And here's the thing. If I just want to test for the robustness of a strategy, just to get an initial idea, is it worth spending any time on? Then I just want this to be 1. So 2 divided by 2 is 1. 3 divided by 3 is 1. So the win-loss ratio is 1, which means that I'm going to enter a trade. I'm going to put this target here. Let's say it's a long trade. I'm going to put the stop here. And what I'm going to say that I'm going to use the same distance. And all I'm testing for is which one will get hit first. No trailing, whatever, multiple R's and stuff. That can come later. I just need to start one simple test. Okay? And this is what we call, and people who are Remek traders, they know that this is what we call a 1R. Very important concept. 1R means that this distance and this distance, A and B, is the same distance. So it's a 1R trade. Reward and risk equals. Now, if I do this, since this is 1, this part of the equation will tell me if it makes sense to delve any further into this research. Does it make sense? Basically, I'm not worrying about this part now. I want to know if I get a positive number. And mathematically, it's obvious from this point on, if this number on this side is even just slightly bigger than 50%, I'm already a profitable trader. Can you guys understand the significance of this? So this is what I'm doing, and this is how I'm going to set up the details. So here's what we're gonna do. In the second order set, I'm gonna enter contract size 0. So there will be nothing in the second order set. I'm just gonna enter one contract, and this is the next one. Where should my profit be? I'm gonna set it to 3 ATRs from the entry, and my stop loss will be the same number. 3 divided by 3 is 1, so this is a 1R trade. There is no second contract, and an important detail, I don't want to trail anything. All I want is just to run some tests and see which one will get hit first. 6,000 times I'm going to enter the market. How many times is my stop going to get hit first, or my target going to get hit first? That will give me a rough idea of whether I should start fine-tuning anything or just throw it out the window. Okay? Therefore, I'm not going to customize anything else. I'm not going to customize the time. I could set the time just to trade the morning session or whatever. No, I'm going to trade 24/7. So I'm going to put the ugly, the good, the bad, and the ugly in the same basket. I don't care. So there will be rotten apples in the basket. I can filter them out later if I want to. So understand the power of this test. Even if with the rotten apples, the test results are pretty good, that's one step towards confidence. Let's see what else. is here. Okay, these settings, I'm not going to change the Keltner. No need to. These are the same settings all the time. Let me see, chop filter. No, everything is the same. I'm not using higher time frame filter. Now, one important setting here, the number of signals. I do need to think about this a little bit. This is just as important, I think, as the number of, as using a trailing stop or something. So this is materially important to my test. Imagine there's a trend, and no trend lasts forever. So later something else will happen. And what tends to happen in a trend, and our software can to some degree monitor this, is the strength, actually quite to some degree, the strength of the trend as the trend flattens out. So I don't necessarily want to start new trades as the trend is flattening out. As a result, I may not want to trade 50 signals in a trend. Anyway, long story short, I may want to limit this number. Later, as you will see, we can run also some optimization tests, quite an interesting to optimize for number of signals, but that will come later. Right now, I want to take the first 5 signals, max, 1, 2, 3, 4, 5, and then anything else. The colors, of course, do not matter for a mathematical algorithm. If I want to send myself an email with every trade, no, so these settings do not matter, okay? One thing matters, if I'm in a position, do I want to exit the position at the session close? Let's switch this on. I mean, it's up to you, but if it's a 15-minute chart, assumes that we're kind of intraday, and one rule for intraday traders usually is that you exit at 4:15 or 4 p.m. New York time. But remember one thing, we're not intraday because we don't have enough money for overnight. Not having enough money on the account, having a small account is not reason to be intraday. Having a small account is reason not to trade. So we are not intraday because we don't have more money, but we're intraday because we have found an edge. Intraday. Okay. So the way it will work is that there's a trend, let's say, and let's say we take the first 3 or 4 or 5 signals, good. And then this is signal 5. Okay, maybe the trend will go to the moon, but we missed that, right? But if the trend does something like this is chop filter active, trades are not counted. And if there's a downtrend or a further uptrend coming out of this consolidation area, then that's when the counting will restart from 1. Good question, David. Thank you. Perfect. Okay, enough talk. Let's run the test. And here you will also see, so 4 years, 4 instruments, 15-minute chart. You can imagine that's going to be a large number of trades. Market order, 1-hour trades. I'm focusing on the accuracy. The real question is, are we going to get more than 50% accuracy? If yes, that warrants further work. If not, well, then we'll talk about it. Let's see what happens. And also, market replay might take hours or days. Watch this. And this is BTX, lightning speed. So there are 4 iterations. You can see it here because I'm not optimizing for anything. It's just 4 instruments over 4 years. That's still a lot of trades. And I'm also on a video. I'm on an i7 here, so perhaps not the fastest computer in the world, but it's fast enough. Look at this. Not even a minute, like 30 seconds, we have altogether 9,000 trades, 9,344 trades altogether on 4 instruments. This is the power of BTX. I do remember the time, this is a place for advertising, so forgive me, but I do remember the time when I ran these tests without our products. And I had to go for a bike ride and then come back and look at the results. I can still go for a bike ride, but not because I have to wait for Ninja to do the test. This is lightning fast. Okay, next steps. Look at this. First of all, performance as always. So the first thing I'm looking at is the number of trades. I need a large number of trades for statistically to be anything to be meaningful. And I might look at the performance. Anything bigger than 1.0 means a profitable strategy. 9,000 trades on 4 instruments. If you think back 4 years, 2019, we had the COVID situation. We had more than a year of flat market on the RTY. The YM hasn't been too friendly for us or to us. Just look at the chart on the daily chart. You'll see that we had some tough times. We are in tough times right now as we speak. So, and we are testing up to today. So these are not the easiest environment. In 2015, 16, we had some markets, remember? We were just going up like a balloon. So this is not bad considering the circumstances. And all the rotten apples, everything, all the trades that we normally would not take, perhaps at 3:59 p.m. Eastern time, we would not enter a trade. Probably there are trades which are taken at hours that we would not probably have entered. Long story short, all 4 instruments show a number bigger than 1.0. I said enough already. We could end the session right here. But let's continue. Look at the percentage profitable. Even the combined results are 52. And it's not 35, not 40, not 25, of course, not 70, but it's 52. This is a very respectable start. I'm happy with the results so far. Of course, this is just the beginning, and I don't even worry about the dollar figures. That's not really, that doesn't matter at this point. Okay, now, one other thing I might want to look at. So this is the gain, but what is the pain? So I want to look at the equity curve. Again, this is a very rough first test, but I do want to look at the equity curve. Could I sleep if I ran this strategy? Well, on the NQ, it's a definite yes. So this is a pretty good equity curve. I'm not expecting the same thing on all 4 necessarily. So let's look at the YM. 99% green. The RTY, I'm waiting for some ugliness here. Okay, well, this is the most ugliness we might get today. Look at this. Hard times, yes. Flat market, yes. But one strength of our strategy, algorithmic strategy, the chop filter, we do our best to filter out flat markets, sideways markets. And RTY spent a lot of time sideways. I know a 50-minute chart is a small chart, but still, with every trade, every setup, every signal, the algorithm did filter out as much as possible the suboptimal triggers. And I think that's the reason why even the bad times, the hard times, are not tragic, just flat. And when things get going, then our strategy shines. Let's look at the ES. I'm waiting for more red. Sorry, guys. This is better than I thought. Here we go. Okay, the ES, dramatic drawdowns. Even we almost gave back all the money that we started with, but we ended up pretty good. So this is just the initial step. Again, it's decidedly rough. This can be improved. Just one obvious example is instead of market order, I might just use a limit order and then give back less of the slippage and perhaps some other stuff. Oh, trailing, obviously, locking in profits. You remember, this is a strategy where either the target got hit or the stop got hit. So by tightening the stop, by using smart trailing stops, these results can be improved. But why don't we stop right here and just as a last thought, give you some ideas. If you'd like to run some tests on your own time before next Wednesday, which I encourage you to do, then, by the way, if you don't own the product, feel free to sign up for a trial for 14 days, 15 days. If you already had a trial and you want a second trial, send me an email. I'll give you one. So a couple of ideas just to close this off, to wrap it up. You can try limit orders and improve the results. I'm not going to show you the NQ. That would not be fair. That's too good to be true. I'm not expecting. Okay, let's stay on the YM. This is reasonable. There's a long flat period here, but still a convincing. Why is this so good? Simply because of a decade of work that we've put in it, and also because this is a strategy that capitalizes on crowd behavior. And as I mentioned before, anything else doesn't make sense because the participants form a crowd. So this strategy is robust because it analyzes crowd behavior. You can play around with limit orders instead of market orders. Then you can use the time filter. For example, limit the time of the trades to certain times of the day. Play around with that. In the lunch hours, US index futures tend to flatten out. New York goes for lunch, so you may want to skip that time. See what works. This now has everything in the basket. No filtering at all. You can limit the number of trades in a trend. Yes, we mentioned that. And then later, you can play around with some risk management settings. Risk management was switched off in this test, you see, because I didn't want to introduce more variables. You want to just use a couple of variables to get started, and then not to fall into the trap of over-optimizing. We're not trying to build a Ferrari that will only take us home in a nice sunny day. We want to build a car that will take us home 12 months, a year, any weather. Less flashy, but works. So let's continue from here next Wednesday. And if you have any questions during the week, then please send them in. We need to crunch the numbers so everybody can really understand the power of this tool. Okay, thank you. Have a great day, guys, and I'll talk to you soon.